think as research analysts, when we're diligencing an investment thesis, it might be highly technical or highly fundamental. But of course, like event-driven catalysts can matter a lot. And what the data shows is that the event catalyst of a Binance listing can pretty materially and consistently lead to favorable returns.
Today's show is powered by SKALE. We'll hear more about them later, but first, let's dive into today's episode.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed.
Hey guys, welcome back to another episode of OX Research. Before we start the show, we need your help. OX Research is conducting an audience survey to help us get a better picture of who our listeners are and what you want to see from the show. Think of this as something like an annual review. What do you like about the show? What could we improve on? And if you want to contribute, visit the link in our show notes below to help us fill out the survey and help us build a better OX. Thanks. Transitioning on from that, today I'm joined by Carlos and Luke from the research team. Ryan Cashflows Connor was too busy. He could not grace us with his presence today. Unfortunate. Carlos, I know, has some maybe some noise issues in the background. Hopefully we don't get too interrupted by those today. How are we feeling today, guys? The last week or two have honestly felt like months, really, with the way that the markets have been acting. The new admin, the Trump admin coming in and sort of like all the different announcements. We had, the DeepSeek scare from a week ago, and then now this past weekend we've had sort of like the tariff scare, and sort of maybe V reversal from that. How are we feeling over the markets now?
Yeah, I mean, absolutely. Like, I think the past month has felt like 6 months. It's been very volatile. Like on January 19, Trump launched his own meme coin. Solana reached $291 per token. Like Bitcoin touched 109. And just like 3 days ago, we were all doom posting on the timeline, thinking it was all over. Like, just the contrast between like the sentiment 2 weeks ago like to this weekend is absolutely like amazing to me. And then I think like the market is starting like to navigate this macro uncertainty. Like we're all becoming macro experts again, like and then like just with the tariffs and what it could entail like for broader markets, not just for crypto.
Yeah, it kind of gives me flashbacks to the 2017 era market, particularly for equities, where we'd see incredible vol spikes kind of moving just off of Trump tweets as it related to tariffs and trade wars and whatnot. What was particularly interesting to see was just the dispersion in returns across Bitcoin and the alt sector. Whereas Bitcoin held its recent range and didn't make a new low, we saw a lot of alts basically retrace their whole move to the pre-election lows. With that, Bitcoin dominance put in a 10% candle to the upside, printing in new cycle highs at about 64.5%. And some of these alt candles like SUI, for example, put in a 50% intraday range. So while the sell-off was like certainly concerning Sunday night, the extent to which we see like huge lower wicks and the market not letting these assets spend much time in these downside ranges is constructive of the idea that there's still a bid beneath the market.
Yeah, it's a great point. I think some of the comments from both of you guys really highlight a lot of the sentiment that I think we've seen in the space lately is that Bitcoin has really just been hanging out. It seems like, right? It's gotten into this range and it's just been chilling here for over a month at this point since rising up off the election. Meanwhile, everyone and their favorite alts, the volatility has been maybe difficult to contend with during that time. So it's just an interesting dynamic. I think people who are here from maybe a prior cycle are completely not used to this. If you were hoping for an alt cycle, it's not exciting to see, Bitcoin dominance pull a 10%, wick to the upside on a move like this. So that is tough to work with. I think like if we re-highlight and go back to, just a week or two ago now, and look at the Trump token launch, there is something interesting kind of coming out of that, is that it had a massive impact on activity and trading volume on Solana. A lot of that has been sort of retraced already. Like there was a bit of a Trump bump, and most of that has kind of disappeared already from at least trading activities. Stablecoin supply still looks pretty strong, but there was something else that we kind of noticed in this madness of the Trump token weekend. Was I believe this would have been during the Melania token launch, actually, where the Jito engine had congestion issues, and essentially like went down for a period of time. The data team, Dan Smith and some others, found some interesting information about different validators running different clients on Solana. We saw in this bottom chart here, the FireDancer and then the Solana Jito and then the Agave clients, and how quickly they regained, or sort of like, were returned back to their normal throughput in TPS following that event. And the FireDancer clients, or I guess it would be Frankendancer at this point in time, but sort of pre-FireDancer clients seem to have, that sort of like best response to that event. So we might be seeing some hints of like the early performance or upside or improvements made to that client. Although I think we're still waiting on like a concrete timeline. I think people are hoping to see, FireDancer go live sometime this year. I don't think that's confirmed, but it's interesting to sort of see this data here and some early hints, at least, at some improvements. You guys have any thoughts there?
Yeah, I guess like I have two thoughts. Like the first is just how crucial Jito has become for for a functioning Solana network. You see that they had like 3 hours of degradation. Like they went offline for 3 hours, and then median priority fees just spiked like crazy. Like there were users paying like, I think Dan Smith said like $50 for a priority fee. Like it's absolutely insane. And then for me, it just highlights like the reliance that the Solana network has on the Jito Solana like validator client, and like on this like out of protocol tip mechanism for transaction inclusion. And then the other thing that I would highlight is like, despite like these issues that we see like on the chart below, like Solana is still operating like maybe a reduced total throughput, but like it's at a rate not possible on other chains, right? Like even if we have like a reduced throughput here, like it's still like no other chain could have handled like the Trump launch as well as like the Solana network did.
Yeah, at large, it's pretty clear that while Solana is hosting some of the highest performance, there's still room for improvement. And as they've been iterating with whether it be FireDancer, Agave, or the new scheduler, network performance can continue to increase, and we can see just a more performant venue for all this on-chain activity.
Yeah, fair points. I think you're definitely spot on there, Carlos. At least in terms of blockchains that get used heavily today, like the base TPS sort of like limitations are up in the low hundreds today. So this throughput would be like inconceivable. But they're obviously scaling. I think it's probably maybe an open question as to whether like something like an Aptos or a Sui can handle this. I just don't know that we've seen the relative amount of demand to drive that much activity on those chains. But the the sort of like testing and capabilities and through the sort of expected throughput of those chains might be able to weather this storm, but it's unclear, right? I don't think we've seen that much consistent aggregate demand on those chains yet. This episode is sponsored by SKALE. SKALE has differentiated itself from other layer ones by offering users a network of gas-free, interoperable EVM L1s where the user experience comes first. Explore the gas-free ecosystem at scale.space/ecosystem and follow their journey on X at SKALE Network. To learn more about the gas-free architecture and growth of the Scale ecosystem, visit the Scale Research Hub at scale.space/research. This episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your crypto and logins, trusted by 7 million users and securing 20% of the world's digital assets. Follow the link in today's show notes to grab your Ledger now. I think this plays in nicely to a recent topic that you've dived into, Carlos, is the introduction of this Jito TipRouter fee distribution that they've just announced and have gone into. So I'd love if you can give us like a quick overview and we can dive into the specifics, like what does this mean for Jito? What does this mean for Solana going forward?
Right. So like just taking a step back, right? Like when users want to include a transaction in the network at the same times as other users, they essentially want to outbid each other, and that gives rise like to priority fees, or what we call competition for contentious transactions, right? What Jito did is that they developed like a parallel auction mechanism on Solana where users like bid tips in order to secure additional transaction inclusion guarantees. And so like on Solana, you have like priority fees, which are like in protocol. And then you have like Jito tips, which are out of protocol tips, generally related to like MEV and that kind of stuff. And so if you look at like Solana's rev, like 55% of that is composed of Jito tips, which is huge because like in the past month, Solana has had more like $500 million of REV, or real economic value, which means like Jito tips are north of $260 million in the past 30 days. And up until now, the distribution of these tips was done manually via an off-chain process. And essentially, Jito just announced the release of TipRouter, which will basically handle the distribution of these tips in a programmatic manner instead of doing like manually via an off-chain process. The biggest beneficiary of this like change is definitely the Jito DAO and Jito stakers, because like previously Jito Labs used to take like a 5% fee on all of Jito tips as a block builder fee, and now the economics have completely changed, with TipRouter charges a flat 3% fee on all Jito tips, and that 3% fee is distributed, as you can see in this chart, like 2.7% goes to the Jito DAO treasury, 15 basis points goes to the Jito Bolt restakers, and another 15 basis points goes to the Jito Bolt restakers. In turn, like both Jito Sol Bolt and Jito Bolt stakers like provide security to the node consensus network. It's essentially like the restaking product of Jito. And then the Jito Labs team reduced their take rate from 5% to 3%. So essentially now the aggregate fee on Jito tips goes from like 5% to 6%. So I know that sounds like a lot. So like if you have like any questions, please stop me there.
Yeah, Carlos, I've got a few. So, per your report, it looks like 44% in annualized real yield to Jito Vault stakers, which is obviously like an incredibly attractive dividend or cash flow carry on that position. So, do you think we see a lot more Jito get staked, or do you think the market value of Jito will rise a lot with this to price that yield lower?
Yeah, absolutely. I think we'll see a lot of Jito staked on these bolts over the next few weeks. Initially, there was a cap like before the TipRouter went live, so that kind of limited Jito's growth there. When I released this note, I believe there was about $11 million worth of Jito locked into these bolts. And due to the sheer amount of like Jito tips and the network, then that meant that the yield was so high, right? So over the following weeks, I would expect a decrease in this staking yield.
Do you think there's any downstream impacts to just generalized on-chain activity as a result of this change, or is everyone is essentially, transaction submitters, basically users? It doesn't seem to change too much for them, but behavior from validators and others, like does this cause any other changes that you're thinking of?
It's a great question. Lucas Bruder, who is the CEO, and co-founder of Jito, just put out a very long Substack post talking about the impact of the TipRouter release, like on the broader Solana validator network. And essentially, this dives into other topics. Like you have SIMD96, which, as we've talked about in previous episodes, it will get rid of the burn on the priority fee. And what that means is that validators will maximize their revenue. And Dan Smith has previously lobbied that SIMD96 should only be approved if SIMD123 is approved simultaneously, because currently there is no way for validators to share priority fees with stakers the same way they do with issuance. And so what Lucas proposed is essentially, now that we have TipRouter to distribute Jito tips automatically, why don't we use the same standard to distribute priority fees? And this has never been thought before, and it would be absolutely monumental for Jito if validators actually adopt TipRouter as the standard distribution mechanism for priority fees as well, because it means Jito is not just earning 6% on the Jito tips. It's basically earning 6%, assuming the same fee structure is maintained on all of Solana Rev, because they would also be distributing all of the Jito tips, all of the priority fees via TipRouter. But this is partly speculation, because we don't know the exact fee terms that implementation would have. But it's definitely an interesting case where there is a lack of an in-protocol way to distribute the priority fees to stakers, and then there comes Jito with an kind of independent solution that may be adopted by the rest of the validators in the network.
Yeah, that could be interesting. I guess if we jump back over to the REV chart, and you think about that breakdown, I mean, I think you highlighted it, but we look at close to 50-50 in terms of aggregate Jito tips versus priority fees. So it would be interesting, if that were a future outcome, to basically see, their revenue stream from this sort of fee router essentially get doubled potentially.
Yeah. The issue is SIMD96 is second in line to be activated based on the Agave version 2.1. So the release is almost imminent, but then the problem is that SIMD 123 is just months away in terms of work. So it seems like a better alternative to distribute it through TipRouter than to just have nothing at all.
Great points. Love the overview, and appreciate the context on that one. I think we're gonna highlight another recent report. We've got Luke on as well to chat about his thoughts about how Binance spot listings impact token prices and performance of tokens. So I guess, Luke, if you want to give some kind of background and intro and dive into that one a little bit.
Yeah, absolutely. So in recent months, just watching markets anecdotally, we've pretty consistently seen large repricings on tokens when they receive a spot listing on Binance. Just to name a few, like Drift, Orca, ACX, Velo. Some of these assets repriced 1 to 200% higher on the day that news was released. So obviously, Binance is the premier global crypto exchange, over $1 trillion in monthly spot trading volumes and 35% market share amongst centralized exchanges. But seeing this meta kind of continuously play out with each listing, it got me pretty curious to see how valuable exactly is a spot listing on Binance to a token's market price, and whether or not we could observe any alpha in this sort of theme. I think as research analysts, when we're diligencing an investment thesis, it might be highly technical or highly fundamental. But of course, like event-driven catalysts can matter a lot. And what the data shows is that the event catalyst of a Binance listing can pretty materially and consistently lead to favorable returns. So if we jump into some of these slides here, at large, what we see across the board is that a Binance listing does support favorable returns across all timeframes. So at T0, the median repricing is 26%. The average is 63%, which are great returns. And then looking out T plus 7, T plus 30 days from the listing, returns continue to be positive. But if we look a little bit deeper at the next slide, is we can note a discrepancy in the returns between assets that perform their TGE on Binance compared to assets that TGE well before a Binance listing and then pursue that listing later down the road. So what we can see for assets that were not listed on Binance at TGE is when they get that listing, the median repricing at T0 is 44% and an average of 100%. And you can compare this to the day of the listing for assets listed at TGE on Binance, and it's 0% and 20.7%. So if you're positioned in a token that is fortunate or lucky enough to get this catalyst, your T0 repricing is an incredibly attractive return, which concurrently suggests that like these spot tokens that have yet to receive a listing are basically trading at 30 to 50% discounts to their market value if they were to receive that catalyst. What's perhaps more interesting, or taking the conclusions a bit further, is that if you look at the returns across all these timeframes, T0, T plus 7, T plus 30, the most favorable returns are exhibited in the T0 timeframe. And concurrently, the probability of positive returns from the event decreases from 90% at T0 to about 70% at T plus 30. So with the most favorable returns at T0, it basically suggests that if you are lucky enough to get this repricing, the day of the listing is a highly favorable opportunity for profit taking on a short-term time horizon, as both your expected returns and the probability of positive returns will decrease in time. And in contrast, I think an important takeaway too is that for project teams, it's perhaps a disservice to their public market investors to pursue a TGE on Binance, as this basically prevents your public market investors from receiving this catalyst. We can see that like the median returns for Binance listing T plus 7, T plus 30 are actually negative if they TGE on Binance. So it's most favorable for public market investors to have the opportunity to take a position, acquire exposure, basically buy the asset at a discount to its Binance listing value before giving your public market investors that catalyst.
Yeah, it's great to see some concrete data around this. I would imagine like a lot of these ideas are maybe things that people maybe have as like loose ideas in their head. You know, I think people generally have that thought that, you know, a Binance listing is a big deal. And maybe it's, you know, hey, it's the liquidity event. It's a sell the news type of thing. You know, you get that boost and maybe you want to capitalize on that. So I think it's great to see some data around this, because I think generally that's just sort of been like a colloquial like thing that people bring up and mention, but you don't often see the actual analysis around it, which is great to see.
Yeah, I think it certainly doesn't serve as a comprehensive investment thesis for any given token, but it's material enough that it should be a component of a broad investment thesis, to understand whether or not you have that potential catalyst on the horizon, but then also to understand that it could be an opportunity to buy the rumor and sell the news. And the news at T0 does demonstrate to be the most opportune time for profit taking on a short-term time horizon.
Absolutely. I think, yeah, it's a very interesting analysis. And I think the discrepancy in result makes sense. Like you can kind of reason through it and justify it as the tokens that were not listed at TGE. Like these are probably projects that are leaders in their verticals. And then they saw significant on-chain demand, and then Binance saw the need to list them, right? Whereas projects listed at TGE are probably like just pre-launch. They probably have to pay some fees to Binance in order to list on their exchange, and so like there's sort of like a selection bias issue here, where you can see like on average, probably not in every case, but on average, the projects that were not listed at TGE probably have a higher quality than those who were listed at inception.
Yeah, great points around. I'd wonder as well. I'm assuming, and I think you limited your analysis to like utility tokens, project tokens here. I'd almost venture a bet that we maybe see some slightly different dynamics for like meme coins or commemorative coins that end up getting listings on exchanges as well. It might be even more in the direction of being like a mass sort of like liquidity event, kind of sell the news opportunity, as they don't have, you don't have fundamental buyers of meme coins, right? There's no revenues. So great data. Any last key takeaways on this one before we jump along? Okay. Well, I guess I'll throw in a point here that for the longest time, like, the large tier one centralized exchanges they've kind of been, like you mentioned, that, that symbol of prestige for a token, and to get a listing there has been a big meaningful thing. But it has actually been interesting to see a slight change in that trend, perhaps. Lately we've seen Coinbase kind of talking about, we need to modify our listing process. We're not actually catching things early enough. I know last year as well, Binance started talking about, looking for things within the community at smaller market caps or that are like gaining attention. And, they may have listed some more questionable, meme assets on a more frequent basis, but we have seen a little bit of like a shift in that trend that has been potentially driven by like this increase in like consumer social based like traction around memes and like just kind of like non-utility trading activity. And that does lead into our next topic, which is around Vector.fun and like social trading apps. Hey everyone, we'd like to give a special shout out to the sponsors of today's episode, SKALE. SKALE is built different. Unlike other layer ones, SKALE is offering users a network of gas-free, interoperable EVM L1s where user experience comes first. SKALE operates like the AWS infrastructure model, where developers pay for space in the network in SKALE tokens to validators. Essentially, SKALE has chain fees and not gas fees. This allows for free transactions on SKALE and has saved 46 million users over $9 billion in gas fees. Explore the gas-free ecosystem at scale.space/ecosystem and follow their journey on X at SKALE Network. Visit the SKALE Research Hub to learn more about the gas-free architecture and growth of the ecosystem. That's scale.space/research. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your transactions and assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional passwords and enhancing your digital security. Follow the link into today's show notes to get started with Ledger today. There was a pretty big announcement, I would say, from the Tensor Foundation, who have the Tensor.trade, or the NFT trading platform on Solana. That team has, over the past few months, recently pivoted into building Vector.fun, which is like a socialized trading app. You could think of Telegram trading bot apps, but adding an additional social features on top of that. So beyond just, swapping memes, there's also, posts. It's tied to your public Twitter account or private Twitter account, but tied to your socials. Can create groups and make trades and like comment on trades with friends or members of those groups. And then users that share trades, like they call them broadcasts in the app. But if you broadcast trades or share links to tokens, and other users use those to trade tokens, the sort of share or refer of that trade or that token gets a kickback of the fees, of the trading fees from the users that kind of act on that. So some similar mechanics to what we've seen. Telegram trading bots employ some of the same mechanics to like sort of drive growth of the platform, convince their early users to get other people onboarded because they get a cut of those fees. But this announcement of sending half of net revenues from the Vector.fun app to the Tensor protocol, and then therefore the Tensor token, is a pretty big revelation. If we look at just NFT trading volumes, this is for Solana specifically, but Tensor is included there. They've really been in decline since last year. There was quite a bit of excitement early last year in 24 around NFT trading. We even saw it with like Bitcoin NFTs, ordinals, things of that nature as well. There was a little bit of a bump here at the end of 24 as well, but basically they've been in sort of like a secular decline, while trading activity on Solana has been basically up and to the right during this same time period. So it's interesting to see them, this Tensor team, transition to a trading app. And we have a dashboard as well that I'm going to share from at Blockworks Research that highlights activity on the Vector app and gets into the revenues that are getting kicked back to the Tensor token now. So commented a little bit earlier on this Trump bump, and you can see that in a lot of the charts, right? Their trading volumes, daily trading volumes, had gone from somewhere in the ballpark of 5 to 10 million prior to the Trump token launch, quickly jumped up to the 20 mil range, and we've returned back to that low 4 to 5 million range, like a lot of other trading apps have done. But the thing I want to highlight here is that this net revenue to Tensor now from Vector is that, in essence, 35% of total trading fees are now getting kicked back to the Tensor token. So this total revenue number is on the order of like upwards of 10 million a year annualized, if we just think about the prior 30 days, which may not be the right comparison now if this Trump effect is gonna cool off here. But given that their prior sort of business model was entirely based on NFT trading, it's a significant boost to Tensor, the token, Tensor the protocol, as I don't think the forward-looking prospects for just NFT trading alone was going to be enough to kind of keep them going. Some of the risks here to keep in mind, though, is that when we look at the Tensor supply, there is a large unlock coming here in early March for insiders in the team. It's on the order of like 120 million tokens. So that's a massive cliff unlock. And then following that point, we get into the sort of highest rate of token unlocks going forward. So over the next year, like we're looking at this T+1 market cap, we're looking at basically a double from the current circulating supply. So that's something to look out for. But I think just generally the kind of ongoing, trend and activity that we've seen of, trading apps that have been gaining momentum. Like if we think about Photon and BullX and these other Telegram trading bots, they've been a massive draw, and they've been absolutely printing on fees. So at the very least, it seems like this Tensor team, like they are keen to sort of being nimble and rotating into like a new direction that they think might have better potential upside for the protocol as a whole.
That's awesome. I'm just curious, like you said 35% of fees are going back to Tensor holders, right? Is that via buyback mechanism, or they like just revenues are going to the treasury controlled by Tensor holders? How does it work?
Yeah, in this case, it's those fees go to the treasury. So I think the way that this breaks down essentially is that Vector earns trading fees. They take roughly 1% on trading fees, like a lot of consumer trading apps do today. Roughly 35% of that, or roughly 30% of that is kicked back to users in the form of, the referral fees and other sort of referral rebates that they have baked into the app. And then that sort of like remaining 70% of total fees is split 50-50. Half goes to, the labs team, and then the other half goes to the treasury for the Tensor protocol.
I'm curious, Danny. So Tensor first launched NFT marketplace, and the token TGE'd at about $1 billion FDV on like pretty paltry revenues. But now they have this new product, Vector, which is printing fees multiples of the legacy NFT marketplace. I'm curious why you think they didn't launch another token for Vector.fun and perhaps use some of the FDV to incentivize activity from users.
Yeah, it's a good point. I don't know that I have a good reason for why they didn't do a second token, other than the fact that I think, like, historically, getting into like multi-token models for like an ecosystem of projects or apps, I don't think those have tended to do well in aggregate. That's just like my anecdotal thought there. But I think historically, when you look at like two token or like multi-token models, I think you would probably tend to end up with just like general underperformance, and it adds confusion to the sort of overall model. In this case, the angle that they've gone with is recently they had the season 4 Tensor airdrop, and users who claimed that within the VectorFun app got like a bonus allocation of tokens. So it seems like they're basically trying to, redirect users and like get them onto this new platform that they think really has stronger legs going forward than Tensor. And rather than sort of like upheave everything that had been built prior, just like keep on with the existing token and unlocks and move forward and ship, which arguably might be the better direction, right? Like if we started again at day zero and with brand new unlocks and more supply, minted to the team essentially, I don't know if that would be viewed in the same positive light.
Yeah, I agree. All that makes a lot of sense. Like, while they potentially could have done another token at $1 billion FDV, two tokens ends up just looking like a cash grab, and leads to confusion within community and what you're building. So it's nice seeing them turn value from their product suite to one token on that mission.
100%. I do feel like we see this. I mean, you think back even to the Trump launch, right? Like people saw the Trump token and then they saw the Melania token. They saw hints about, the Barron token, people talking about, World Liberty Financial. I think a lot of that, and he's had other previous launches prior to that, right? Different NFT collections, and, you can buy Trump watches. I don't think the community views that in a positive light. I think it really begins to look more like grift rather than, like a sort of serious team that's building a meaningful product. So I would guess, like, maybe from a reputation standpoint, a credibility standpoint, this seems, I think it gives them a little bit more of a seriousness in terms of, we've already have the token with our unlocks and we can just build this new app and drive the fees to it. I think continuing on this trend though, that like social trading apps have really become like a big topic and like growing sort of part of the industry. Obviously, like Telegram trading bots have continued to grow. Those things print cash, but we've seen more attempts at like, friend tech like apps. There was Tribe.run, there was that Clout.gg app. We just saw recently there was this Flaunch launch, this Flaunch app launch on I think on Base, using like something of a pump fund like design, but they've integrated UniV4 hooks and they have like some more interesting like tokenomics baked into the model here for like launching and trading tokens. And I think the general gist is that creators can launch tokens and then can define like a certain amount of the fees from trading those things that either go to the token itself as a buyback, or basically turn, some portion as fees to like the creators or the protocol, and then another that like some portion that can go to the token itself as a buyback, rather than fees just like entirely going to like the pump fund team in their example. I'm curious, do you guys have any thoughts like where we might see like social. I think there was a big sort of like excitement around social fi as a category, and friend tech really did not pan out. And even some of these newer apps, like they maybe had excitement for a day or a weekend, but those don't seem to last. But like just generalized like trading of meme coins has seemed to be pretty resilient. Do you guys have thoughts about like how teams might further socialize just the basic aspects of trading, to keep themselves going forward?
Yeah, I think we'll increasingly see like innovation around the LP mechanism for meme coins. Like we saw this meta where you'd launch a meme coin to either crowdfund some initiative, whether it's donation for someone's cancer treatment, or giving a huge percentage of the supply to Zach XBT. And while those models can effectively like crowdfund large sums of capital for a certain endeavor, implicit in it is that a huge percentage of the float is going to get dumped for that end. So I think we're going to increasingly see like the LP get monetized as a way, as being the way to fund whatever that common good or initiative is. I think one such model is like Pump.Science, where the LP fees that accrue from the meme coin trading volumes end up being used to fund science experiments for longevity research. Ultimately, I feel like that's higher expected value for participants in the game, where they can speculate on the up and down of the meme without the implicit need for the end party to rug a large percentage of the float.
I think this is a great example of what you're really highlighting here is, and just mentioned, like, so Flaunch, they're saying they rehypothecate ETH liquidity via UniV4 hook, which is interesting. So basically earn yield on some of the LP by just converting, the ETH that's getting traded in and out of these pools, and working with a restaked token instead, to earn yield on that liquidity. And like you mentioned, this opens up like it's more of those sort of financial games like under the hood around, now that the liquidity is earning some value, like what can we do with the earnings from the liquidity? Can we pay the team without having to take fees from users? Can we, allow for buybacks on the individual tokens? It opens up a lot of different like styles and rebrands of this game, I guess.
Luke, would that be enforced like at a protocol level or like a token level? Like I'm just imagining, right? If there's like a donation meme to X or Y celebrity or whatever, like these people may not be like experts on the matter, and they may just like sell their tokens. Like, what is there an actual way like to enforce this to happen?
Yeah, it's really project by project, of course, and how they implement it. I wouldn't expect celebrities to be particularly adept at innovating the LP smart contract logic. That being said, I believe like the LP code for the Pump.Science tokens are they're not the Pump.Fun default. They're built out of the Pump.Fun protocol to basically like custom architect the fee logic to accrue the LP yield outside of the LP position. So adjacent to the burnt LP position to a venue that can then sell the fees to fund any particular initiative.
That makes a lot of sense. And like, do you think like regulatory clarity impacts any of this like at all? Like 2 weeks ago, we saw like David Sachs mention like NFTs and meme coins are both like collectibles and they're not like securities under like the SEC law. Do you think like eventually people will try to game the system, right, and like use these types of like meme coin mechanisms to their advantage, and just it's inevitable that bad actors like come into the scene? Like, do you think there's going to be some like sort of like regulation around meme coin launches or like legal liabilities?
Yeah, so most meme coins don't look like securities. There's no expectation of profit in the endeavors of a common enterprise. That being said, like pump and dump schemes can still apply, and to the extent you're putting out false information to artificially inflate the price of some instrument, I still think meme coin creators can be liable for pump and dump schemes.
Yeah, I think on the other side of that equation, like there's also this future where we're seeing this gradual shift of it used to be all animal memes, and now we're getting to like commemorative tokens about people or companies. We might see as like the regulation gets kind of cleaned up and pushed out. We might see that trend all the way to the point of basically launching utility tokens via these platforms, assuming it's clear, given regulations around it. I think for the longest time, right, it's been all memes because like they kind of have to be. You can't promise utility and not be scared of the SEC coming after you. But that could change, and we could see something like a pump or a similar platform like go after just generalized token launches for anybody, not just these degens, but it could be for serious teams as well. Well, I guess coming up, like there's some interesting things coming, like new chains. Berachain has just announced their mainnet is going to launch on the 6th. We're still waiting for like more news from some other chains, like Monad is still TBD. The Mega ETH guys are still building. Hyper EVM, like still waiting for some updates there. I'm curious your guys' thoughts. Like Berachain has been one that's like been around for a while, and it's felt like, are they ever actually going to ship this thing? So it's been, I don't know if it's exciting or just like more of like a finally to get news that it's actually coming out. I know the Boyko sort of like deposits are in the billions. It's giving me a little bit of like Blast vibes in terms of like, hey, deposit your ETH and whatnot for a while before we launch the chain. Do you guys have any strong feelings like going into this launch? It should go live the day this episode comes out. So if you want to have any hot takes here before Berachain drops.
Yeah, my mild take is it certainly seems to be like one of the most hyped launches for a new chain that I think also in turn has the most room to disappoint. And it's unfortunate to say that. That being said, like, yeah, there's a lot of deposits showing interest in moving to the chain, farming airdrops, farming yields. Then concurrently, that crowds out and dilutes any expected yield I can get for moving my deposits over there. And I'm not too interested in locking up some deposits for duration to clip a pretty paltry coupon from any yield or airdrop. So I'm not averse to going over there and farming it, but I kind of need to see it actually go live and see what gets me going to actually put some money in it.
Yeah, I totally agree with Luke. Like, I would just like wait and see what's actually on the chain after it launches, and then see if something interests me. But as of right now, yeah, it seems like it's too hyped, and like when something's so hyped, like it's meant to disappoint.
Yeah, I think that's fair. The one thing that I think is interesting about the Berachain approach that we're not seeing from any of the other sort of like maybe soon to launch or early stage projects is that there's sort of like a notable lack of a focus on like being a high throughput chain. Whereas if you look at the Monads, the Hyper EVM, the Mega ETHs, it's all of these are trying to like compete in this world of lots of users, lots of transactions, like be really fast, lots of throughput. Berachain's going a completely different direction, right? It's like different liquidity games, like earn yield on your deposits, things of that nature that are sort of like baked into the protocol. So yeah, I guess we'll see. I think you're definitely right, Luke. It's tough to look at like the amount of deposits today and think that like you have some edge by dripping some extra cash in there yourself. But I guess we'll see when it launches. Like maybe there could still be some interesting opportunities when it goes live if there are pools or other things to get involved with and farm. But we'll just have to see, and we'll find out here when this one goes live. Awesome. I think that was a great app, guys. Any big takeaways or maybe just like things we're excited about going into the next couple weeks and months? Anything interesting that we're looking at that we've been getting excited about?
At large, I think 2025 regulatory climate, you're going to continue to see protocols turn on fee switches, redistribute cash flows to token holders. And those protocol tokens that look just like equities are going to get priced more in line as such. So we have Jito TipRouter, Tensor cash flows, Aave umbrella, and buy and redistribute programs going to go live soon. So ultimately, it's nice to see that like these funny money governance tokens can actually get some cash flows and the value in turn with that.
Yeah, I totally agree with that. I'm also interested to see like the most recent proposals are just like buyback mechanisms to accrue value back to token holders. I'm genuinely like curious to see if any of these protocols will implement a fee switch where the value accrual looks more like a dividend, where the stakers of the token actually get some of the cash flows and it's not via buyback mechanism, and if there's any like impact on the value of the token itself, like the way they distribute the value back to the holders.
Great points. I think certainly like looking forward, I think there are some solid tailwinds just generally for the industry to be excited about. It might not result in anything material in the coming weeks or even months, but longer term, like it's I think from a regulatory and sort of incoming legislation perspective, we do seem to be in a very, very positive period going forward. Hopefully, just given the admin stance and many of the folks involved with the admin today and their attitudes towards the space. So that's been great to see. But yeah, I appreciate you guys coming on today. This was a great app. Great to dive into your thoughts and theses around some different projects today. And we will see all of you guys next time.